Welcome to this explainer. Okay, so picture this. You've just finished a completely grueling month at work. You finally get that alert on your phone. Boom, you've been paid. The money is officially in your account. But what actually happens next? Today, we are going to follow a single paycheck on a wild journey through the hidden, honestly, kind of crazy mechanics of our economy. We're pulling back the curtain on how the financial system really operates, with a special focus on the hidden mechanics of bank reserves, from the exact second you earn your cash to the moment it actually starts working for you.
Right. So you walk into a bank branch, you hand a teller your cash, they smile, type some stuff on a keyboard, and you walk out. Easy. And most of us have this super comforting image in our heads, don't we? We like to think our money is just resting peacefully inside some massive, impenetrable steel vault, maybe guarded by a dragon, just waiting for us to come back and claim it. But the reality? The literal second you turn your back, that money is already gone. It has embarked on this wild adventure through the financial system.
So here's our roadmap for today. 1. The cost of civilization. 2. Inside fractional reserve banking. 3. Interest, the silent engine. 4. Inflation and economic resets. 5. Mastering the trust algorithm. And finally, 6. Buying time through investing. All right, kicking things off with Section 1, the cost of civilization. Let's look at where your money goes right off the bat.
The weirdest part about currency is that it's not actually real. Seriously, think about it. There is literally no more intrinsic value or legitimacy to a piece of paper with a president's face on it than there is to a random stick you find on the ground outside. The only reason a dollar bill can buy you a latte and a stick absolutely cannot is because we've all collectively agreed to trust it. Money is, at its core, just an illusion. It's a social construct built 100% on shared belief. And because we all live in this shared society, we have to pay to maintain it. I mean, we've all felt the pain of checking a pay stub, right? You earn $2,000, but somehow you only get to take home $1,456. It feels like this painful modern ritual where your hard-earned cash just vanishes into thin air to some invisible force. But, as this quote beautifully reminds us, taxes are literally the cost of civilization. It is the price we pay to ensure there are paved roads, functioning schools, and health inspectors making sure your favorite taco truck isn't infested with rats.
Let's break down exactly where that government cut is going. First off, income tax hits the money you make. Sales tax hits the money you spend. Then you've got capital gains tax, which takes a slice of the money your investments make while you're sleeping. Then there's Social Security, which is basically the government forcing you to save money right now so they can pay it back to you when you retire. And Medicare, which is a tax that pays for health insurance for older folks or people who are sick. Now look, I know taxes can be incredibly annoying, especially when you have to play that guessing game of how much you owe every April, but generally speaking, countries with higher tax rates actually boast a significantly higher overall quality of life.
Moving right along to Section 2 inside fractional reserve banking. This is the big one, guys. How banks actually operate.
So, what actually happens when your post-tax dollar enters the banking system? Like we said earlier, when you deposit $1,000, the bank absolutely does not put it in a safe. Instead, they play matchmaker. They'll take, say, $900 of your deposit and immediately turn around and lend it out to someone who wants to, buy a jet ski or start a small business. The bank only keeps a tiny slice, just a fraction, on hand in reserve. This whole setup is called fractional reserve banking, and it is the heartbeat of our economy. It relies entirely on the mathematical probability that not every single customer is going to show up on the exact same day demanding 100% of their cash back. You provide the supply, the borrowers are the demand, and the bank just sits right there in the middle, facilitating the whole thing.
But what happens when that trust-based probability completely breaks down? Well, look at 2008. That year is a pretty stark reminder. Back in 2008, the trust that literally holds this entire fractional reserve system together just evaporated. People panicked, and they actually did line up to withdraw all their money at the same exact time. And because the banks only kept a fraction of those reserves on hand, the entire system crumbled. It just goes to show how incredibly vulnerable and utterly dependent on trust this massive economic engine really is. Now hold on, don't go withdrawing all your cash and stuffing it into a shoebox under your bed just yet. To keep this fractional reserve system from totally collapsing every time there's a bad rumor, governments step in with a massive safety net. In the U.S., for example, most bank deposits are insured up to $250,000 per person. This means that no matter what crazy things happen to the bank's loans or the broader economy, the government flat out guarantees your money is safe. That insurance is the crucial glue that keeps public trust intact so banks can actually keep lending out their reserves and fueling economic growth.
Okay, Section 3, interest, the silent engine. Let's talk about the actual price of money.
Think of interest like this. It is simply money's way of charging rent to exist in someone else's hands. When you borrow cash, interest is the price tag for using someone else's money. But when you deposit your savings into an account, the bank actually pays you interest. That's your reward for being a patient, boring saver while they use your funds to go make all those loans we just talked about. Let's look at the two different flavors of this silent engine. Simple interest is basically a flat fee. It's like, here's your cut, thanks for playing. But compound interest? Oh man, that is where the absolute magic happens. Compound interest means every dollar you earn makes little clones of itself, and then those clones start charging rent too. Now, if you owe 20% interest on a credit card and you miss a payment, that compounding effect is a slow-burning fire that can turn a $12 burrito into a $50 regret. But on the flip side, investing your money at a 7% annual compound interest rate is basically a real-life cheat code. Your $100 becomes $200, then $400. It just continuously duplicates your wealth over time.
That brings us to Section 4, inflation and economic resets. Let's look at how the value of your money gets eroded. Have you ever opened a bag of potato chips, realized it's mostly just air, and then remembered you paid like 30% more for it than you did last year? Yep, that is inflation. It is a slow, steady erosion of your money's purchasing power. And it usually happens for three main reasons. First, too much demand. This is when there's way too much money chasing way too few goods. Like if 2,000 people want to buy a TV, but the store only has 1,000 in stock, they're obviously going to raise the price. Second, supply chain hiccups. These just make producing and shipping things way more expensive. And third, consumer expectations. If we all think prices are going to go up tomorrow, we all rush out to spend our money today, which ironically drives prices up even faster. It's totally a self-fulfilling prophecy. To fight this inflation, governments usually raise interest rates to cool down all that spending. But cooling things off can push us directly into the next phases of the economic cycle. Think of the economy like a massive party. During the boom phase, the drinks are flowing, everyone is dancing, life is great. But eventually, reality hits, we reach a peak, and the DJ starts playing sad, lo-fi beats. This leads straight into a bust, or a recession, which, technically speaking, is just the economy shrinking for at least 2 quarters in a row. Jobs vanish, people stop buying stuff they don't need, it's tough, but it's absolutely vital to remember that recessions don't last forever. They're just natural, albeit painful, resets before the growth party can start up again. All right, Section 5, Mastering the Trust Algorithm. Let's talk about your credit score. This 3-digit number is basically a shadowy, behind-the-scenes metric that knows your entire financial past and judges your reliability. Ranging from 300 to 850, your credit score is literally the key to unlocking loans, mortgages, and decent interest rates. But here is the absolute most important takeaway. This number is not a measure of your wealth. Not at all. It is a strict measure of trust. Lenders are simply looking at it and asking, if I give this person my money, are they actually going to pay me back? Drop below a 580 and you are basically a walking red flag. But get over a 750, you are absolutely sparkling with adult credibility. So how do you actually win this game? Well, it comes down to 5 main factors. Payment history is by far the biggest one. Do you pay your bills on time? Then there's credit utilization, which is how much of your available credit you're actually using. They also look at the age of your credit history, your mix of different loan types, and how much new credit you've recently applied for. Honestly, a credit score is a lot like a pet dog. If you ignore it, it's going to make a total mess of your life. But if you feed it with consistent, on-time payments, it'll happily help you buy a house. And here's a crazy fact. You can have absolutely zero debt, millions in the bank, and still have a terrible credit score if you don't have a history of playing their game. It's entirely about looking good to lenders. Finally, Section 6, Buying Time Through Investing, how to actually multiply your wealth. There are 4 main vehicles you can use to put your money to work. First, stocks. These let you buy tiny little ownership slices of real companies. Second, bonds. This is where you get to play the bank. You loan your money out to governments or corporations in exchange for interest. Third, funds. These are just big collections of stocks and bonds bundled together so you don't have to stress about picking them one by one. And fourth, real estate, which is obviously buying physical property, but the overarching principle here is a massive mindset shift. Investing is what happens when your money stops sitting around on the couch and starts actually working for you. You're no longer trading your time for a paycheck, you are trading your money to get even more money. And the absolute secret ingredient that makes every single one of those investment vehicles work? Time.
Most incredibly wealthy people out there didn't win the lottery. They don't have magic psychic powers. They simply gave compound growth 3 solid decades to do its thing. Time is the single greatest force in wealth building. Money that just sits quietly in an investment account multiplies. It happens slowly at first, sure, but then it snowballs incredibly fast. That is exactly how ordinary people with completely average, modest paychecks can retire with 7 figures in the bank. They used the system, and they gave it time.
Which brings us to our final thought for this explainer. You do not have an unlimited supply of time, but it absolutely remains your most valuable asset. The top earners in the world have figured out how to train both their hours and their dollars to work for them through the exact financial systems we've explored today. So I want to leave you with this. Now that you actually know how the machine works, how are you going to use your most valuable asset? Thank you so much for joining me for this explainer, and I absolutely cannot wait to dive into our next topic with you.